Hi, everyone. Thanks for joining. I'm Bhuva Shakti, a global product operations and fundraising advisor, helping businesses build systems for growth that actually last. For more than 25 years, I've worked at the intersection of technology, finance, and operations, first on Wall Street, leading digital and AI powered transformations, and later in angel and venture capital ecosystems, helping founders launch products, expand markets, and attract investors. That blend of structure and innovation is what I now bring to startups and small businesses, helping you grow with clarity, scalability, and financial confidence. Beyond workshops like this, I also offer one to one coaching sessions customized around your priorities, whether that's product and customer readiness, operations and expansion readiness, or fundraising and investor readiness. We can focus on one area or build a combined plan that meets your current and future needs. If you'd like to explore what that might look like for your business, I offer a free 30-minute consultation over Zoom. It takes 2 minutes to submit this form on my website. The link is on the screen. Let's start with what we'll cover today. First, we'll define what angel investors actually do and how they differ from lenders or venture funds. Then we'll break down the angel funding journey step by step, how to find investors, prepare your materials, and approach your first meetings. Next, we'll dig into what readiness really means financially, legally, and operationally, so you know exactly where you stand before outreach. Finally, we'll end with a readiness checklist and a few clear next steps you can take this week. First, why angel funding matters. Angel investing exists because traditional capital doesn't always fit early stage businesses. Banks want collateral, grants take time, and VCs usually wait until you've already scaled. Now, this is where angels step in during that middle stretch, when you have traction but still need belief capital. Beyond money, angels often bring expertise and relationships. Many are former business owners themselves who invest locally or in industries they know well. They can introduce you to partners, suppliers, or mentors, connections that outlast the check. So, as we go through today, don't just think about raising money, think about finding a partner who helps you de risk and accelerate your growth. That mindset changes how you build relationships from the start. For example, a New Jersey craft beverage company raised 60K from an angel who also owned a distribution firm. That investor's contact got them shelf space in regional grocery stores. That's value far beyond the capital itself. Angels typically invest between 10K and 250K and mentor early stage companies. They expect their returns in 3 to 7 years. Every funding story follows roughly the same rhythm. You identify potential investors, make contact, pitch your business, go through due diligence, close the deal, and then manage the relationship. We call this the angel funding lifecycle. It might sound linear, but it's actually a loop. You'll refine your materials, learn from each meeting, come back stronger for the next conversation. Most founders go through multiple touches before the first yes. The goal isn't to rush it, it's to move through these steps deliberately with enough preparation that each stage builds credibility for the next. A clean tech startup in Ohio spent 3 months mapping 50 local investors and sent 10 personalized emails, landed 4 meetings, and closed 100K deal. It wasn't overnight, but each step fed the next. There are a few myths that hold founders back from pursuing angels. The first, angels only fund tech companies. Not true. Many invest in consumer products, manufacturing, food, and community services. Second, I need huge revenue first. Early traction matters, but investors know small businesses grow in stages. They care more about a clear market and a plan to reach it. And finally, it's all about the deck. The deck opens the door, but the relationship wins the deal. You're selling trust and execution, not slides. Angels invest in founders first. They want to see character, clarity, and commitment. A great product with a hesitant founder rarely gets funded. They also look for clear markets and realistic growth potential. You don't need to promise national domination, but you should show how your business can grow sustainably and profitably within its niche. And they look for exit pathways, how they'll eventually see a return. That might mean acquisition, licensing, or profit sharing. Be upfront about your long term vision. A small e commerce startup selling eco friendly stationery raised 75K because the founder had 1,000 loyal customers and a repeat order rate of 40%. That traction showed scalability without hype. To set expectations, even though individual angel checks range from 10K to 250K, multiple agents typically pool together with a range of small to medium checks to facilitate a full investment round for a startup that typically ranges from 100K all the way up to $1 million or more. The process can take 3 to 6 months, longer if your materials aren't ready. Investors usually take 10 to 25% equity, depending on valuation and risk. Knowing these averages helps you plan your fundraising timeline and prevents unrealistic targets. It also reminds you that smaller checks can still be meaningful. They are proof points for future investors. Let's pause and look through the investor's lens. An angel's main question is, will this founder use my money wisely and give me a fair shot at return? They're balancing their interest with caution. That means they pay close attention to your judgment. Are you disciplined about numbers? Do you take feedback well? Do you know where the money will go and how it drives growth? When you communicate transparency and preparedness, you reduce perceived risk, and that's half the battle. Investors fund clarity and confidence far more than slides. Now, let's walk through the 6 steps of the process. This is your fundraising map: research, outreach, pitch, due diligence, terms, and relationship. Every successful round touches all 6, sometimes looping back as you refine. These steps aren't meant to be complex, they give structure to what can otherwise feel random. Think of them as checkpoints. You don't have to be perfect at each one, you just need to know where you are and what comes next. As we go through them, jot down which step feels like your next move. That's your homework after this session. Not to do everything, but to move one step forward intentionally. Everything starts with step one: research. The best investors for your business are the ones who already understand your industry, your region, or your mission. Instead of blasting 100 emails, study who invests in businesses like yours. Use tools such as AngelList, Crunchbase, LinkedIn, or even your local SBA directory. Look for overlap, shared interests, geography, or sector focus. The more aligned the investor, the smoother every later conversation will be. Remember, fundraising is matchmaking, not cold calling. You're looking for partners who bring value, not just checks. A food tech founder was searching for New York culinary investors and found a chef turned angel who had funded 3 similar companies. Their shared background created instant rapport and a 50K investment. Now, step two. Once you've found your targets, it's time to reach out carefully. The goal of your first message isn't to raise money, it's to start a relationship. 2 or 3 clear sentences are plenty. Introduce who you are, what problem you solve, and one traction point, then suggest a short call. Avoid attachments, jargon, or long asks. Respect their time, and they'll respect your clarity. When possible, use warm introductions. Mutual contacts, alumni networks, or community events. A known name in the subject line triples your response rate. Now comes step three, the part everyone thinks about first: the pitch. But a good pitch isn't performance, it's clarity. Your deck should be short, visual, and focused on the story behind the numbers. Cover the essentials, the problem, your solution, who it's for, early traction, your team, and what you're asking for. Leave investors wanting more conversation, not less. Practice it out loud until you can tell your story comfortably in 5 minutes. Investors back founders who sound like they understand their own business better than anyone else. A cybersecurity startup refined its deck from 20 slides to 10, practiced the 5-minute delivery, and raised 120K from two angels who said, finally, a founder who knows what to skip. If the pitch sparks interest, investors move into verification mode. That's step 4, due diligence. This is where they review your financials, contracts, customers, and any liabilities. Don't panic. This isn't an audit. They're checking for organization and honesty. Keep your files tidy and labeled in a single online folder. Professionalism here is a green flag. The smoother your diligence process, the faster the close. It signals that you treat their money and your company seriously. A SaaS founder created a shared Google Drive with financials, incorporation papers, and product screenshots. The investor said that level of readiness sealed their 100K decision. Once diligence checks out, it's time to talk terms. That's step 5. This is where you decide how the investment is structured, typically a safe, convertible note, or direct equity. If those terms sound foreign, that's okay. Your job is to understand the basics, what you're giving up now, what could convert later, and what expectations come with it. Ask questions early and never forget to involve a lawyer before you sign. Investors appreciate founders who protect themselves wisely. It shows maturity, not mistrust. Now, the last step is step 6, relationship. Funding isn't the finish line, it's the start of a partnership. Once money hits the account, stay in touch. Send updates every quarter, milestones, wins, lessons, and next steps. Good communication keeps investors engaged and makes follow on rounds easier. They become advocates who open doors, introduce contacts, and even defend you when times get tough. Treat investors like team members, not ATMs. That mindset builds trust, and trust compounds faster than capital. A local health tech company sent its investors a 2-page monthly update with metrics and one clear ask. 6 months later, one investor introduced them to their first enterprise customer. Now, let's talk about where to actually find these angels. So, there are investors in every region, especially through local angel networks, startup and small business communities, university innovation hubs, and the regular conferences. Before reaching out, build a short, focused list. 10 to 20 aligned investors is better than 100 random names. Document their background, portfolio companies, investment range, and contact method. Use a spreadsheet or CRM tool to track who you've contacted, when, and what happened next. Fundraising is relationship building. It's organized follow up, it's not spam. You'll find that when you treat investors like long term partners rather than transactions, even no responses turn into introductions later. Now, let's talk about valuation. It's simply the price of your company today, how much ownership investors get for their money. Early on, it's more art than science. Investors look at traction, team experience, and comfortable deals to estimate value that are more or less in the comparable range for the current market trends. Don't get stuck on the perfect number. It's better to choose a fair range and focus on the story behind it. A reasonable valuation builds trust faster than one that sounds inflated. If you're unsure, use resources like PitchBook data, startup valuation calculators, or mentors from your local networks. A local SaaS company estimated their pre seed valuation at $1 million. based on 100K annual revenue and comparable deals. They offered 10% equity for 100K and closed in 2 months. Now let's simplify the two most common angel funding tools. The SAFE, also known as Simple Agreement for Future Equity, and the convertible note. Both let investors give you money now that converts into ownership later when you raise your next round. The difference is legal complexity. Safes are simpler and don't accrue interest. Convertible notes act like short term loans that convert later with added interest or discount. These tools keep deals fast and founder friendly, but always review terms with an attorney before signing. Understanding how dilution works now prevents surprises later. A New York EdTech founder raised 80K using a safe at a $1.5 million cap. When they raised a 1 million seed round the following year, those early angels converted smoothly with no renegotiation stress. Once both sides agree, it's time to close. The final stage involves signing documents, confirming back transfers, and celebrating, but quietly. Don't announce funding until the money is actually in the account. Coordinate with your attorney or advisor to ensure every signature and wire is complete. Send prompt thank yous and receipts. It's professional and signals reliability. Then breathe. You just completed something that less than 2% of small businesses ever do, raising private capital. That accomplishment deserves acknowledgement. Once you have raised money, your role shifts from pitching to performing. Angels expect regular communication, usually monthly or quarterly updates, summarizing sales, milestones, and upcoming goals. Good reporting builds reputation. It keeps you top of mind when angels talk with their peers. Your name becomes associated with professionalism. Use updates to ask for help too. Investors love actionable requests, introductions, partnerships, or advice. It turns passive backers into active champions. A digital marketing startup sent quarterly two-page updates with metrics and one specific ask. Within 6 months, an investor connected them to a national retail client, doubling revenue. Let's finish with what not to do. First, overpromising. Be ambitious, but back every claim with data. Nothing erodes investor trust faster than inflated projections. Second, ignoring follow up. If an investor asks for updates or documents, respond quickly. Silence kills deals faster than no. And finally, fundraising before you're ready. Spend time preparing your story, numbers, operations first. Confidence comes from clarity, not luck. Thank you all for joining today's Startup Growth Playbook session on securing angel investment. Raise your first round. I hope this gave you a clearer picture of how angel funding works and, more importantly, how you can prepare your own business to access that capital. If you'd like to keep building on what we covered today, I offer one-on-one coaching sessions designed to help small businesses and startups to move from ideas to action. We can focus on product and customer readiness, operations and expansion readiness, or fundraising and investor readiness, or create a blended plan that fits where you are right now. Each session is practical, focused, and tailored to your next step. You can schedule a free 30-minute consultation call with me over Zoom so we can map out what kind of support would make the biggest difference for your business. It takes 2 minutes to fill out the form on my website. The link is on the screen. Before you go, take a moment to reflect on one action you can apply this week, whether that's reviewing your pitch deck, refining your customer story, or updating your business metrics. Small, consistent progress compounds. I'd like to help you keep that momentum going. Thanks again for joining.